Hey guys, and welcome back to the Ginger Realtor Show. It is Monday, which means it's Mortgage Mondays, and it's the last Monday of the month, which means we have Baret Kechian with us from Loan Depot. Baret, thank you very much for joining us again.
Happy to be here.
Baret, it seems as though things have gone from mad to worst over the last couple of weeks since we last spoke. Interest rates are on the up. War is decimating Western Europe. Try give us some good news.
There is light at the end of the tunnel from what we're hearing. Yeah, we had one of the economists that does a lot of predictions on the mortgage market and really goes into the statistics and stuff, speak to our entire company on Friday. And he said, look, right now inflation is driving everything. Mortgage bonds, there's just a lot of them out there and not enough buyers, which is what causes the bond prices to fall and the rates to go up. And this is going to be our new normal for a bit. I mean, there's no great news in the immediate future. So to me, the one thing he told us is there will come a time within the next 9 to 12 months where you're going to see a break. As fast as these things went up, there will eventually be a number that comes down. And I think at this moment, he's saying that the market's not necessarily going to go down on the prices because there's still 32 buyers to every house. So even if it knocks out 10 of them, there's still 22. So in reality, the prices of homes may not come down. So if you really need to move based on space, you may have to pay a premium for the next, 8 months, 12 months, maybe 18 months, and pay these higher rates right now just to get into the home with the eye on refinancing and just making sure you're keeping in touch with your loan officer over the next year and a half to make sure they know that you're going to be ready to go the second that you see a 0.5%, 0.75% drop. And I do firmly believe we'll see that. So while I know it stinks for a lot of these buyers who are shopping in December to see their rates go up, almost 2%. I think there will eventually be a reprieve and it won't be a forever thing. You're not going to pay $400 a month extra for the rest of your life. You may pay it for the next 12 months, but I don't think it's going to be forever. So with a lot of clients, we're continuing on the path of if there's a short-term loan, like an adjustable rate mortgage available, do it. Because one way or the other, I don't think you're going to keep this loan past the next 2 years.
No, and I think there's a lot of panic about the number on the interest rate. It's not that long ago that 4.5%, 5% was seen as historic lows, and it was a great time to buy, a great time to refinance at 5 and at 4.5. So I think there's a lot of panic. I think the fact that COVID pushed things down, and obviously the last government, they decided that they were going to go heavy into mortgage-backed finances. And the bond market there, so that propped up the housing industry a little bit during the COVID thing. Whether it's just the current, I don't know personally whether it's just the current president and his policy is not to back them at the same level, or whether we're at the same level.
I think inflation has a lot to do with it. Inflation has gotten to a point where, with gas prices where they are, just with everything costing so much more, people not able to get furniture for months and months, the supply chain issues. That stuff's gotten so high that they have to do something. And there was talk of the R word, recession, which we might see over the next 12 months or so. And at that point, you'll finally see, I think people maybe get back into the bond market and you'll see rates start, coming just back to earth. I think there's a happy median between where things were during COVID and where they are now. I think 4% 30-year fixed rates is a healthy market. And if it's there, that's 0.75% less than where we are right now on most conventional loans.
So right now we're right around 4.755 as an interest rate. How much higher do you see it getting before we start to see some relief?
I mean, if we get through this latest resistance point on the bond market, you can see it going to the mid fives. Even he was saying they can go as even high as 6% and touch that short term until they start to rebound at some point. The increases that the Fed is doing is not something that is having an effect now. That's all been built in. I mean, they've gone up 1.75% since December. I think that's what has already been built in. The Fed increasing rates will have no impact on what we're doing here, but it's just been, and even the arms and all that stuff has gone up. And the problem during times like this is you'll see some banks start winning more deals because for a while, the banks were not irrelevant. We were, as mortgage lenders, we were taking every loan almost because they just, they weren't better in rate and they certainly didn't have the service. So now they'll have some rate numbers that might be beneficial, but their service hasn't gotten any better. And when they get busier, they don't get better. So, you have to almost make a decision at some point to say, all right, you know what, I'm just going to close this thing. I'm going to own my house. I'm going to go in and do everything with an eye on refinancing. And I know in 12 to 18 months, I'll have something better than this 4.75 rate. And I think if you go in with that mindset and know that it's not forever, it never has been. I'll put it that way. You can't predict it exactly on timing, but we've never seen rates just stay high for a long, long period of time. The last 10 years, we've had 4 refi booms.
I think if you look at the rates that we're paying now, I think we've got used to almost unrealistically low rates, because you look at the rates that our parents paid and in the 80s and early 90s, and you're looking at 15, 16% in some cases. So I think we've been spoiled a little bit. I definitely don't see a drop off from a real estate side of things in the amount of mortgages that are going to be processed, because there is so much competition for so few homes. I listed a new home at midday and I had 10 calls by 1 o'clock.
Yep, that's exactly what we're seeing. It's crazy
how many people are looking to get into the market, even with the higher rates. And now that you know that you can get in at 4.5%, 5%, and maybe a year from now drop it down to a whole percentage point, then it kind of protects your investment and it gives you a kind of, it's easier than renting.
I think people have to realize that their grandparents giving them advice is not necessarily the thing, because the market is so different now than it was during their time. When rates were at 18%, like you said, and then got down to 12 and 10, and when they hit 8, they were like, oh, you better lock in. You want the fixed rate forever. I think you can play these markets with adjustable rate mortgages and get them for 7 years, 5 years, 10 years, whatever's available to you. If there is something available, use that to your advantage, because the market is so cyclical now, much more than it has been in the past, that you can 3 years in, 4 years in, you'll get a refi opportunity. And even if it went to year 7, I mean, it's not a chance that we don't see these things cycle back at some point in year 7. You just have to be awake, and you have to be able to respond to your loan officer when they reach out. We reach out to all our clients, certainly, and we did the last 2 years. If we see opportunities, like we see rates at 4% after where they are right now, we will call every single client who closed in the month of March and April, just to make sure we let them know that there's availability for savings, so that's how you have to do it. And we have, as a team, you have to have that mindset. And as a client, I think, you're not going to not buy a house, because next year that house might be 5% more, like you said.
Yeah. And I think even as a realtor, knowing what our buyers are getting as far as a rate is, it adds value to us to be able to call them a year down the line going, hey, look, I know you're happy in your house, but rates have dropped significantly. I think you should have a chat with Baret or with whoever they got at the time, and have that conversation. That extra $200-300 a month in their pocket is better in theirs than in some lenders just sitting there doing nothing.
I think we see enough of that. That's true. The problem, like I said, like if the banks end up starting to do more loans, because they're a little ahead right now, maybe on price, you're going to see a significant drop in service, and you're going to see under appraisals again. You're going to start to see loans not closing again, and we're going to end up with the deals anyway. It keeps happening. Like this week we had, I was on vacation this past week, and there was 69 applications or something that came in, which was the highest number we've had for our team in the whole year. And so with the highest rates that we've seen year to date. And so it's not stopping anyone from applying for mortgages. We sent out, I think, 50 pre-approvals this week. So people are still looking to buy. And I think they have to, just with the eye of, hey, even if I pay a little more now, it's not forever, just going to bite the bullet. And then,
I mean, if you look at the market from my side of things, your buyers are paying a mortgage, whether it's theirs or somebody else's. So either way, a mortgage payment is made. And 9 times out of 10, when you're looking at renters, they're paying more than the mortgage would have been anyway. So in a
rents
lot of
have gone up just as much. Yeah.
It's having that conversation and telling people about unlocking their 401ks to be able to pay for deposit, or taking a gift from a family member so they can get the down payment, so they can get into the home. So, you may still be paying, and again, I'm dual market, so it might be $1,500 in Virginia or $3,500 in New Jersey, but at least that money coming off your equity, coming into your equity and off your loan amount, as opposed to sitting in a rainy day fund for a nameless, famous, faceless corporation that maybe bought up a number of houses in the last drop.
Yeah, no doubt. I mean, again, as long as you feel like the homes are going to continue to appreciate, and that seems to be the indication based on how much demand there is versus how much supply, you'll get into the market. Your rate doesn't have to be your rate forever, but you get into the right price at that house and start paying down the principal. And it's not going to be a house you're in necessarily for a year, right? You're buying these homes, these aren't stocks. So if you're in this thing for 10, 15 years, your equity will be protected. And at some point you'll get into that rate that you really wanted from, last year, we'll hit 3.5 again, we'll hit 3.75 again. And those are good numbers. We may never hit 2.5 again, like we did last year, but I thought that was, overdone anyway. I think there's a happy median somewhere in between.
No, I 100% agree. And I think the bigger issue is the fact that as a populace, we're so transient these days. We're not spending 35 years in a house and owning the deed on our first house the way that our parents and grandparents did. We're upscaling, and then we're pulling it back, and we're downscaling once we empty nest. So I think there is that kind of circle of life for homes, where you start off with your small starter home, and then you build up and you build up and you build up. Then the kids go off to college and leave, and then you're like, okay, don't need this big one now. Let's push it back towards the starter size. And so I think 7 to 10 years is an average. And on a long shot, I think once you have a more established family, you're more likely to do that 7 to 10 years.
That's right.
3 to 5 now is what I'm seeing. I've got buyers that I bought houses with 3 years ago that I've already sold their homes.
That's right.
So
if you're a buyer that's buying in like the higher end markets that, let's say, are like loan amounts of above 650 or so, you're not doing Fannie Mae, Freddie Mac back loans right now, even if they're offered in the area you're in, like in New Jersey. Yeah, we have a high cost area, obviously, but you're doing a jumbo loan every time if you're eligible. Now, what comes with that is, there's more guidelines. They're a little stricter. They'll take a little longer to process, but you have to make sure you're working with a lender that has access to those. Because if they're offering you their conventional loans only, then you're just going to see rates that are close to 5% and over. Whereas a jumbo loan for that same loan might be down at 4%. So, pretty sizable difference between the two. So you want to make sure, whatever lender you're working with has flexibility and has both, and can manage that extra process. It is tougher. There's no question. It requires more, organizational, ability to be able to close these things now than it did last year. Anybody can close a conventional loan and close it quick. Doing these jumbo loans that have actual guidelines that you have to check are definitely much harder. So as a real estate agent, I'd say, the one thing I would do is make sure you leave a little extra time than you would have maybe last year when everybody wanted to close in 30 days. Maybe stretch that out to 40 or 45 to make sure you give it enough time, especially for the bigger buyers. If it's still conventional FHA, 30 days is fine. For the jumbo stuff, an extra 10 days wouldn't hurt, just because there's more appraisal requirements, there's more reviews, and just things like that. But it's going to get the client a better rate. So it's worth it as long as they qualify.
So you just stole my closing question from me, because I was going to ask you, with the increase, and obviously you said you had 59, 69 applications.
Yeah, 69 applications that came in, yeah.
I was going to ask you how that's impacting your turnaround time from offer accepted and processing the mortgage to closing. And obviously jumbo, you're looking at 40 to 45 days.
Yeah.
We still turn around those conventional FHAs in around 30 to 40 days.
I would say conventional FHA 30 days is totally fine. I think the jumbo stuff, like I said, or if we're doing a specialty arm or something like that to help a client out with getting a better rate, an extra 10 days wouldn't hurt. So about 40 days. We're actually still staffed from last year. We didn't really have any layoffs on my team, maybe with the exception of 1 or 2 underperformers. So really, we were handling twice as many loans as this, even a year ago. So to me, we have the staff to be able to close quick. It's just they become harder loans also. So you just have to be cognizant of that. And it takes good communication with the client. So they know, when they're choosing that loan, they're going to get a better interest rate, which is great. But then they're also going to have to get you more documents at a timely manner. They're going to have to verify some more things. And as long as you say it up front, and as long as people are aware of it, it's communicated properly, nobody's mad because they know that it was expected. It's when you surprise them with it. I think that happens in our industry, unfortunately, too much, because there's a lot of loan officers that just don't talk about it. They just want to, get the loan, move it to their processor, move on. That's a terrible way of doing business. Same thing, I'm sure, in your industry, in the real estate industry. You want to make sure you set the expectations properly. And if you do, there's no question. Everybody knows that it was already discussed and people will do it. And they're getting much better loans over it. We're still seeing, as of last week, we locked jumbo loans at 3.75 and things like that. So they're happy, those people, because they would have had a much higher rate otherwise. They're happy to provide the documents.
Well, Barrett, thank you very much for taking time out of your busy Monday. Obviously, the first Monday back after vacation is always hectic, so we appreciate
fun.
that.
No
Obviously, the
problem at all.
takeaway that I have is that Barrett doesn't have enough work to do at the moment. So, guys, let's get more mortgages over to Barrett, and I'm sure he'll be happy with that.
That's
Barrett,
right.
it's a pleasure as always. We will see
Thanks,
you
man.
again in 2 weeks. Again, thank you
Look
very
forward
much
to
for
it.
agreeing to do these videos. Guys,
Anytime.
that's all we have time for this week. Thank you very much to Baret Kechian from Loan Depot. We'll pop his contact information below him so you can reach out to him if you have any mortgage questions. That's all we have time for this week. We will see you next week back with Eric Klein from Southern Trust Mortgage. For now, take care.